During the holiday season or all throughout the year when your favorite store or online platform has a huge sale. Do you panic or do you participate? Well, today we're going to talk about how you can participate during market corrections using an investment portfolio strategy called core and satellite. Let's chop. Market corrections, crashes, and bear markets and pullbacks, they don't feel well in the moment. So, how do we manage the moment and not panic and perhaps participate seeing opportunities? Well, today we're going to talk about an investment strategy called core and satellite and see if that could be of use. Hi, I'm Dr. Preston Cherry, founder and CEO of Concurrent Wealth Management, where we help you align your life and money so you can live your wealth your way. All right. And if you like what you see, hear, and feel on this show, please hit that like and subscribe button and share with your family, friends, and colleagues. All right, let's chop. Market corrections don't feel well, and they happen about a couple of times every 1.5 years or so. And those market corrections are 10% drawdowns from the peak of the market. Pullbacks are about 5%. And then those sudden crashes are 20% down from peaks. And then bear markets follow crashes pretty much. And those are two negative cycles of GDP, gross domestic product. Now, we had a whole show, check it out right before this one, talking about all about what corrections and pullbacks are. So check that out. What about corrections? Because they're kind of in the middle right there. And what do you do during those times? A lot of folks tend to see these corrections and even pullbacks, the 5% type, as panics. And we have to acknowledge how people feel in those moments. I mean, folks are trying to build up their wealth over time to retire when they want, whenever that may be, and also probably near retirement or even living in retirement. So portfolios are real when market corrections happen. So those feelings are valid. That said, if we know more information about our emotions and how the market works and what our near and long-term goals are, then that may mitigate some of that panic and see opportunity, seeing through the fog, seeing through the trees, right? That's opportunistic investing. And there's a strategy called core and satellite that you can use with your investment portfolio that may be able to help you navigate the volatile markets. Because one thing about markets, they go up and down over time, and over time, they tend to be going up, over 10, 15, 20 years of time. But within those brackets of time, there's 1 or 2 year periods that doesn't feel very well, even months or weeks, right? So how do we take advantage of those long-term performance of the market by seeing dips in the market at a weekly, monthly, and annually? Well, here it is, right? So first of all, what happens when stocks go on sale? Again, we have a whole episode on that. However, I just want to reiterate that bear markets and bull markets, bear is when the market is not performing well. And in the bull markets are when the markets are performing nicely, right? And bull markets tend to last a lot longer than bear markets. So if you can wade the water, so to speak, put a floating device on a little bit and wait out bears, then you can get to the bulls. Bear markets tend to last about 280 days, whereas bull markets last about 991 days. So it's about 3 times the amount of a bear. You don't want to miss the best days in the market after a drawdown in the market, right? So one of the things I want to share with you is that, corrections, they happen more frequently than crashes, but the recovery periods after corrections tend to be about 4 months. But with crashes, it tends to be about 20 months, 24 months, a couple of years, right? Let's look at COVID. COVID was a sudden crash of about 34%. Now, that recovery period took about 4 months. Now, when you're talking about the elongated bear market after the financial crisis, that took a little longer, well, more than a few years in order to recover. But that's the difference between a correction and a crash. A correction about 4 months historically, and a correction a couple of years. When we saw what happened with the dot-com and the financial crisis, those took a little longer to recover from as far as the crashes and subsequent bear markets. But on average, it's a couple of years. When we zoom out, right? I know that's a cliche term. When we zoom out, these smaller periods are followed by longer periods of recovery, and also over time help long-term investing and fund the long-term goals that you have. So when the market comes down some, this is where you have opportunity where you can buy things on sale. And having a list of stocks that you're looking at over a period of time, then you can say, okay, this is what I've been looking for. It's kind of like when you have a clothing item or something that you want and you have it on your buy list, right? And you say, you know what, when that goes on sale, I'm going to get me some of that. Same thing you can do with stocks, right? So what is this core satellite investing thing, right? Well, when you have a portfolio, you've probably heard of 60-40, and this is the allocation to equities and then 40% to bonds. And basically, it's about diversification and not being overly invested in one or the other, but particularly having so much equity risk where when the market happens to be volatile, then you're exposed, 100% exposed to the market. And it's even worse if you're exposed to a single one or two stock, then and you don't have anything to cushion it, then that stock you're going to feel all the downward pressure. That said, if if you happen to pick the right stock, then you get to experience 100% of the up. That said, it's very difficult to pick those unicorns, as you can say. So folks like to be diversified and not have your eggs all in one basket. Well, when you have a diversified portfolio, your diversified portfolio is your core, okay? Your core, and then it's bookend by a satellite portfolio, and then that's your entire portfolio. Your core portfolio typically consists of your allocation mix, your 90-10, 70-30, 80-20, 60-40, with low-cost ETFs or index funds, right? And you have a globally international approach to your portfolio. That is your core. That is the one where you're consistently investing in over time, dollar cost averaging, and that is your long-term portfolio that's doing the work. All right. Your core portfolio is going to be your engine driver. And then what's up with the bookend, right? The satellite approach. Well, in that satellite approach is where, when you see market corrections, you can take advantage of opportunistic investing, and you have some cash on hand in that portfolio where you have your list of stocks that you've looked at, or even your sector funds, index funds, ETFs that represent, say, the technology sector or industrials or retail, whatever your liking is. And that's the thing about your list, right? It takes time in order to research and stay abreast on the individual stocks, seeing what type of economies that they perform in. There's just a lot of research to do when you have 3, 4, 5 best ideas that you want to follow. Put them on your list, perhaps set alerts on them so you can know what's on your radar. So when the opportunity presents itself, then you can go in your satellite portfolio and purchase those positions, right? So when you have a core and satellite approach, the satellite approach either serves as something that can help your portfolio over time when you're looking for those best ideas, that give a little alpha, is what they call it, a little booster, and also avoid having your entire portfolio in single stocks, or 3 or 4 or 5 of them that you would have in your satellite portfolio. And when those go down, then you're exposed to 100% of those drawdowns, right? So you have a diversified portfolio, which is your core, and then you bookend it with your satellite, and you may have, say, 80%, something to the effect of your satellite, you may have 80% to your core portfolio and then 20% in your satellite portfolio, or 90-10 or 95-5. It depends on your time horizon, and it also depends on your capacity for risk, right? And where you are in your life cycle. So it all depends as far as your personal allocation of the core portfolio and your satellite portfolio. Here's another thing about your satellite portfolio. And there's a lot of talk about crypto. So this is where you can place your crypto purchases without having a drastic effect on your overall portfolio. That goes to crypto is just like single stock. A single position of one or two can serve as a alpha and a grower of your portfolio over time, but it can also, uh, if that's your entire portfolio, then it can leave you exposed. So this is a good way to have your long term portfolio bookended with, which is your core, bookended with the satellite portfolio, and place those best ideas and crypto, if you like, in that area. All right. So how do you go about picking your best investments, your best ideas? So how do you go about looking for things that interest you, positions that interest you in your satellite portfolio? Well, it's a combination of things. First of all, this takes time, and you want to try to build a system where you are not having to go in and look at real time information and invest in things that you don't know about. It takes a lot of research, right? So you want to look at the combination of what you call fundamental factors. Is that stock heated up, so to speak? Meaning, is it selling at a premium or at a discount? That's your PE ratios. How do you identify buying opportunities to see how do you want to purchase the things that you take interest in and you are well researched in order to say, you know what, that item is on sale? Well, it's a mix of fundamentals and technical analysis. Fundamentals are those areas to where you're looking at a few, 3 or 4 or 5 of your best ideas as far as single stock purchases are concerned. And you're saying, what is that company's balance sheet look like? What does their outlook look like? What has been their recent earnings reports? What are their debt levels and cash flows and PE ratios or price earnings? Is it expensive or is it cheap? All those fundamentals are going to go into your research and see if it's a good buy. Also, you have technical analysis where you see the charts and you see all those squiggly lines and all that type of stuff, right? Well, they have a certain technical analysis, like you have your relative strength index, which shows whether a stock has been overbought or oversold. And you also have your 200-day moving averages. So if it's coming close to the 200-day moving average, then you may want to pick some of that, or even if it's below, right? Then that lets you know if it's on sale or not, right? So these are all mechanisms and there's so many more. There's so much more to go into fundamental and technical analysis. This is not that type of show to jump in there. And at Concurrent Wealth Management, we are not traders. So we are long-term investors, and the core satellite approach helps you with that and gets a little bit of best of both worlds, right? So there's a lot of ways where you can be on the lookout for opportunistic times to where you can take advantage of market corrections and not panic, but participate in your portfolio during times to where everybody is selling. However, you are potentially buying, right? So we have these sales all the time in our stores and our online platforms, and we don't use the same attitudes towards the stock market, right? So we need to be looking at these opportunities sometimes as a time for growth, long-term growth, and a little booster, perhaps, when you're buying stuff on sale. And then over the long term, you're starting from a lower price. And when that price goes higher, you have a higher gain. All right. Now, the market always doesn't go up, but if you're starting from a better position and you're satellite portfolio, then you've increased the probability that your gains can be a little higher than other price points. That said, in your core portfolio, if you are dollar cost averaging over time, meaning you're contributing money to your accounts, to the market, week over week, month over month, right, annually, all that, it's a consistent investing over a period of time, then you're buying at many price points, low, medium, high. And those average out for an average purchase point of your core portfolio. Then when you're talking about your satellite positions, then you are looking for those low points. You can't time the market to an exact. So please remember that there's timing. You cannot time the market. There's time in the market, not timing. However, there are opportunities where you can see that say, you know what, that looks like that's a pretty good deal. Let me pick some of that up, right? So that's how you go about with your core satellite approach. And I wanted to have to say this disclosure, and I wanted to say this at the beginning of the show. This is not advice for you because we are financial advisors at Concurrent Wealth Management. And if we know your position and we have a direct one-on-one relationship with you, then we can provide advice. Now, there's something I wanted to share with you at the top of the show, which is these shows, of course, are education and information for your journey. They are not advice because we don't know what your position is, right? We don't know where you are in your life cycle. We don't know your risk tolerance. We don't know your resources. We don't know your goals. So we cannot give advice here on the show. However, this is insightful information that you can consider on your journey, and even when you can take to a financial advisor or planner of your choice. All right. When we're talking about market corrections, it's not all panic. And we can prepare ourselves as far as mindset and position in our portfolio to stay the course in your core portfolio and in your satellite portfolio and take some advantage of some opportunity, right? So being prepared to not panic, but participate can help you over time with your investment journey. All right. That's what we got for you. If you like what you see, hear, and feel on this show, please like and subscribe and share with your friends, family, and colleagues. And until next time, we'll chop soon.